My name is Chad Koehn. So this podcast is brought to you by United Capital Management and the Redneck Yacht Fund. And we're going to talk about taxes and accounting today. I want to first tell our guest, David and I met here a few months ago and together trying to acquire a CPA firm, which is still on the table. But David are you a Texan?
I guess I was not born in Texas, but I've lived there for a long time. So.
And where were you at prior?
Minnesota, and then prior to that, Australia.
Australia, so that's the accent.
Yeah.
So we're going to talk about taxes today. When I first started 32 years ago, I would have accounting firms and CPAs solicit me, pretty consistently for my business. The last 10 years, and more so even since COVID, we have clients asking constantly, hey, do you know a CPA because mine is retiring? I understand that the CPA profession since COVID has lost maybe 33%.
Yeah, and there are a lot of young people who are not entering the profession. And so it's becoming a challenge because the older folks are leaving and you don't have a lot of new folks coming in.
And so we constantly get asked for a recommendation for a CPA and or accountant. Made it very clear to every firm when we started services that we're not here to compete for tax business. We're here to just fill a void. Okay, so you will do tax returns for those clients that have lost their preparer if you've been in the profession a long time. But new business for us, you have the time to take on a smaller clientele and do pretty extensive tax planning.
The model that most CPA firms have been following out there has really been about building up as many clients as they can. And so they become experts at tax compliance, but not strategy. And unfortunately, they're not able to answer the questions. In fact, we just picked up a client where he asked his previous CPA a question and it took him 10 days to respond. And so this is really about coming up and working with clients to share with them strategies in which they can save and reduce money. And we're not talking nickel and dime stuff. Tens of thousands of dollars that many of these people have been overpaying just because their CPAs haven't been spending time with them.
Yeah. Let's talk about tax strategy. I'm going to start throwing some of these out, and we'll start with the simple one first. We'll put a disclaimer today. We may talk in general about some things, and to get the detail or letter of the law, you'll have to meet with David. But Augusta Rule.
Yeah, so Augusta Rule really, bottom line is it's a way that you as a business, you can rent your own house for yourself, take a tax deduction for your business, but not pay taxes on what you receive personally. And you can do that up to 14 days out of the year. So it's a great way to get an additional tax deduction for your business.
And how it got named the Augusta Rule is the Masters golf tournament. Now, during that golf tournament, I presume there's companies that need that golf course for 14 days. That's probably where the 14 days come from. Down there, you can take a big deduction. Now, if you live in Booker, Texas, or Lincoln, Kansas, or Alma, Nebraska, I bet it's a little different.
It is. And there's definitely some paperwork that has to go along with that. And so anybody that we work with tax strategy, we have all the paperwork, we have the model to do exactly what you're talking about, calculate what the fair market value of lease is. Because you're exactly right. What you can deduct in a small town versus New York City is going to be very, very different. Mm-hmm. But we have everything that is needed to be able to claim that deduction.
But we're talking about it potentially tripling or quadrupling the time it takes to prepare a tax return. But if your taxes go from $80,000 to zero, I think it's worth the time, well worth the time. And let's talk about a Roth conversion.
Well, Roth conversion, the conversion itself is not going to save you taxes. Well, in the short term, it's not going to save you.
Long-term strategy.
Long-term strategy, yeah. So one of the things with Roth conversions is there is this thinking, oh, let me wait until I hit 65 or 67 and my tax rate goes down. The problem is that for folks who invested with, UCM in particular, if you're in your
Thank you.
50s and, I've seen what UCM is returning. And so what happens is that people balk at paying, well, I don't want to pay, 32, 37% taxes right now. But here's the math on that. At a high level, if you have, if you're paying, and we'll structure the conversion, but if you're paying taxes, 32% taxes on $1 million and you're 50 and you're not going to touch it for another 15 years, that $1 million may very well have grown to 3 million or more, right?
Mm-hmm.
Now, yes, your tax rate may be lower, but I guarantee you the amount of taxes you'll pay at the end is going to be far greater. And so that's one of the things we're doing is developing a model and showing folks how to do that conversion.
I talked to a couple today. They're young and retired, passive income, but if they don't start doing a Roth conversion now, it's reasonable, very reasonable to believe that their required minimum distribution at age 75, in this case, I think, age-wise, maybe it's 73, but either way, could easily be $240,000 a year. That's a lot of taxable income.
Yeah,
especially if you have income from real estate and things like that. To me, that Roth conversion, it's been there for a long time, but it needs revisited, much due to the part that 500,000 million accumulated by a 50-year-old today could result in a enormous RMD at age 75 or later if they push it. But makes it even a little easier on that next generation to inherit tax-free money as opposed to taxable money inside of an IRA. So those were the two easy ones. This one's a little more complicated, and we don't have to do a seminar class on it, but let's talk about accelerated depreciation and the changes in the recent tax law and what that means.
Yeah, so the most recent tax with the One Big Beautiful Bill, what they did, it's referred to as 179 deduction. It's really about if you're buying certain types of equipment that you can claim the full amount as a tax deduction. And they increased it to $2.5 million.
For 1 year?
For 1 year. So
So we're talking farm equipment?
You're talking farm equipment.
Oil and gas exploration, Bitcoin mining.
Yeah.
All right, we're in our Bitcoin room.
But then on top of that, they brought back 100% bonus depreciation. Why that's significant is because with a 179 deduction, you cannot create a net operating loss. But with bonus depreciation, you can. So if you do the investment that you're talking about, and the 179 brings you down to zero, we can then do bonus depreciation to take you below zero and create a net operating loss, which eliminates your taxes.
Okay, let's talk about depreciation on real estate. You've been sharing that with our staff and our clients, and
it burns me because so many. If you go into your typical CPA office and say, I've got a rental property, they're going to depreciate that over 27 and a half years, just automatically without thinking about it. But the reality is the tax law allows you to take the value of your house and split it out between components and the outside walls. And those components, we can accelerate those components, which links back to what we were just talking about with, equipment. And so you can, if you've got a rental property, then you can accelerate a portion of it. Or if you've got commercial property, because one of the things that if you've got a business where you have your own building, then we can take that building and instead of depreciating it over 39 years, which is typical we can accelerate that and again, bring you back into a situation where we can significantly reduce your income for that year. And we would also structure things a little different to take advantage of that. If you've got any kind of real estate as a rental real estate or real estate as part of your commercial operations, then we really should talk, because it's called a cost segregation study, and we can accelerate your depreciation and get you a lot of money back.
What's the approximate cost of a cost aggregation study?
So probably we're talking, it depends between commercial and non-commercial, but non-commercial regular, we're probably talking about $1,500, or so.
So it used to be around Kansas, people would own $40,000, $80,000 rentals. Okay, some of those rentals now are, several of them that could sell for $300,000, and that makes it, a lot more enticing for sure.
Well, the other important thing there is tax law allows us to change the accounting method. We can change it even if you've had the rental for a few years.
Yeah, when you depreciate like heating and air, HVAC, plumbing, can some of that be done in 1 year, or is it 10 years, or what's the depreciation schedule change to from 27 and a half years on the?
So typically that stuff will get depreciated between 5, 7, or 15 years, depending.
Gotcha. Trying to match the life of it.
Trying to match the life of it, but again, we have a choice between either getting it all in 1 year, or if you'd prefer not to do it, we can do it over the 5 or 7 years, but give you a greater depreciation each year.
831B captives. We're not going to get into that today, but I'll just put it out there. There's a way for business owners to write off $2.8 million annually. And I kind of find it funny, if you don't make any money, you pay taxes. If you make some money but not enough money, you pay taxes. But if you make a whole bunch of money, there's no reason to pay taxes. You can afford not to pay taxes is kind of the way it works out. Long-standing joke with my clients, there's income tax evasion, that's black. I say income tax avoidance, that's white, so black and white. And the avoidance part, the gray part in the middle, where a lot of companies are profitable by pushing that tax law to the limit. But everything we've talked about thus far, I'm going to put in the lily white category. You're going to find some clients that just think that maybe this is almost in the gray area, and it's not. And so that's worth mentioning.
There's one other one I want to touch on that can save thousands of dollars, and that is folks who are still operating either as a Schedule C or an LL business. Because what is happening in their situation is they are paying self-employment tax on that. Whereas if we can change their entity structure, self-employment tax is 15.3%. And if we can change your structure, we can eliminate right off the bat, just thousands of dollars.
What you're going to run into with reluctancy in this part of the country is farmers feel so burned by that. I don't know if it goes back to the 80s or 90s, set up corporations. And then when the tax rates changed, okay, unwind those corporations. And they feel like, if we go that C Corp route, we're going to get burned.
Yeah, I wouldn't. This is setting up an S Corp as opposed to a C Corp.
Phone number?
My phone number here direct is 785-833-5333.
Okay.
If you want to email me at davidellis@ucmts.com. Yeah, happy to, if you reach out, happy to set up, give you a link, set up a call, and see what we can do for you.
Your address is 239 North Santa Fe, Salina, Kansas, with DocuSign and video calls like Zoom and Teams. It's very easy to do business long distance today, and they can do business here with you through May, and might have to reach out to you in McKinney, Texas after May, but hope to have you back. We'll have a little test run here. If you listen to this entire podcast, we will send you a complimentary copy of The Big Print, a book written by Lawrence Lepard, who's doing a great thing. Larry Lepard, Lepard. We'll send you a free complimentary edition of that book. Larry's tired of signing those books, but I'll sign it. I typically put the date, the time, where the U.S. debt clock is, approaching 39 trillion, the price of Bitcoin, the price of gold, and the price of silver. It is a great financial history book. So thank you, David.
Thank you, sir.
Appreciate it. Thanks for being on with me today. Goodbye.